So they say Leo Ltd specializes in the manufacturing and selling of sports clothing products and is listed on the Johannesburg Stock Exchange. Leo Ltd is a wholly owned subsidiary of Panther Ltd since its incorporation. You are a recently qualified chartered accountant and recently started working at Leo as a financial accountant. You are preparing the financial statements for the financial year end 31 December 2020 and have been provided with the following information. Okay, so you know the year end 31 December 2020. So the financial year is 1 Jan 2020 to 31 December 2020. Okay, not important information. I mean, there's just two companies, the parent Panther and then Leo, the wholly owned subsidiary. Wholly owned subsidiary just means Panther owns 100% of Leo. And then you can see they listed on the JSE. Not so important for our purposes. That one sentence that is listed on the JSE is important for financial management, in valuations, and it's important in auditing, okay, as part of your risk assessment, what you call it. You have a financial statement, overall financial statement level risk assessment, and then you have what's other risk called the assertion level. So being listed on the JSE would be an overall financial statements level risk, okay, not an assertion level risk. So important for auditing and important for financial reporting. I mean, for financial information, for financial management, for financial accounting, not so important. Just to give some background. Okay, so the only important thing really here is the financial year, 1 January 2020 to 31 December 2020. So we have preference shares. So say Leo issued 800,000 compulsory convertible preference shares. Okay. So what's important, when you issue, that means you will have a liability. Okay. When you acquire, then that means you'll have a financial asset. Okay. So here you can see compulsory convertible preference shares. So when you see the word convertible, it means you have a compound instrument. Okay. A compound instrument means there is a debt component and there is a equity component. In this case, it's compulsory. Sometimes it's not going to be compulsory. Okay. So this one is compulsory. So that means there's going to be, you're having preference shares for a few years. And then once the preference shares expire or comes to an end, the term comes, let's say 5 years. Once the 5 years come to an end, at the end of the 5 years, you're not going to give them cash, but rather you're going to pay them back with equity shares. So there's a compulsory one. Then you get one that is just convertible at the option of someone. So the one that is at the option of either the issuer or the holder is when at the end of the period, let's say at the end of 5 years, then at that point in time, you will decide whether you, whoever can decide, will decide how the settlement takes place. Will it be settled in cash or will it be settled with equity shares? Okay, so that is when someone has the option. Only two people can have the option, the issuer or the holder. So the holder is the one that has the asset, the issuer is the one that has the liability. Okay, in this case, there's no option, it is mandatory, it's compulsory. So there's no option of paying in cash. We have to pay with shares. Okay, so there's going to be a debt component and an equity component. So Leo issued, take note, issued means you have a liability. So when you issue, what's happening? You're giving a piece of paper. The paper is this instrument. Okay, so I'm giving the holder a piece of paper saying that they have these shares. In exchange for that paper, they give me cash. So I'll say debit cash and credit. If it wasn't a convertible instrument, I'll credit a liability. But because it's a convertible instrument, I'll say debit bank, credit liability, credit equity. Okay. Okay, so here they say convertible preference shares at an issue price of 10 Rand. So that means so the cash I received 800,000 shares times 10 Rand. So it is debit bank, 800,000 times 10 Rand, and then we're going to credit equity and credit financial liability. Okay, so and the preference shares on 1 July 2020. Okay, the convertible preference shares have a face value of 11 Rand each. Dividends are payable annually on 30th June at 12%. These preference shares are compulsory convertible on 30th June 2025. So how many years is that? 2021, 2022, 23, 24, 25. So it's a 5-year period. At 1 ordinary share for each preference share held. A market-related interest rate on 1 July for preference shares issued without conversion rights is 10% per annum. Okay, so you will see what is the purpose of this thing. So remember, when you have a convertible instrument, it is known as a compound instrument or a hybrid instrument. Okay, so I think that the correct term is called a compound instrument. A compound instrument has two parts, the equity component, the debt component. Okay, what is the debt component? That you have to pay a fixed dividend every single year, and you basically have to repay back the capital. The equity component is that the repayment of the capital will be in shares. Okay, that's the equity component, is that the repayment component will be in shares. So therefore, when we say debit bank, we would have, if it wasn't a convertible instrument, we'd have just said debit bank, credit liability. But in this case, because it is a convertible instrument, it's a compound instrument, we will say debit bank, but we're going to have to credit liability and equity. So we have to split it between debt and equity. The way we split it between debt and equity, we work out the fair value of the preference shares, assuming there is no equity component, and that is what this is doing over here. A market-related interest rate for preference shares issued without conversion rights. So we use this information to work out the market value of the preference shares, assuming that there is no equity conversion. So let's say when we work it out, it comes to 700,000 Rand. So then that means if we work out the market-related rate, and let's say the market-related rate comes to 700,000 Rand, then that means the equity component will be 100,000 Rand. 800, let's just assume this was 800,000. 800,000 Rand minus 700,000 Rand gives you 100,000 Rand. So the equity component is a balancing figure. Okay, so just take note of that. So that is the importance of this. We want to work out the market-related rate of the preference shares as if there is no conversion. So they say Panther purchased 800,000 preference shares when they were issued and does not hold them for trading purposes. Okay, so so if it's not held for trading purposes, it can't be fair value through can't be fair value through profit or loss. Okay, so Panther purchased 800,000 preference shares when they were issued and does not hold them for trading purposes. When you trade in instruments, it will automatically be fair value through profit or loss, because trading is similar to like buying and selling groceries. Okay, so for example, like Pick n Pay, buying Coke and then selling Coke. That is Pick n Pay trading in Coke. So when you trade in instruments, it is also operational, so it will be classified at fair value through P&L. The fair value of one convertible preference share was 12 Rand on 31 December 2020. Okay. I'm not going to read this. You can work through this for CTA level 2. This is share-based payments. Okay, so we'll deal with number 1. Number 3, bond at fair value. So Leo purchased a foreign bond on 1 January 2020 for its fair value, which also equaled the face value at this date. Okay. Leo correctly classified this bond at fair value through other comprehensive income. You don't have to do classification. They told you what you need to do. So once again, you purchased So that means you have a financial asset. Okay. So you gave someone money in exchange for that piece of paper. So you have an asset. What's the asset? The future benefit is that you would receive dividends, or you would receive whatever you're going to receive, interest or coupon payments. And then also you can receive like the fee, the capital gains and all of those type of stuff. Okay. Okay. The bond has 5 years to maturity and carries an arrear annual coupon rate of 8% payable on 31 December each year. The bond coupon rate is equivalent to its effective interest rate. Okay, there are no transaction costs, nor a premium or a discount on the redemption of the bond relative to the face value. Okay, so this is very important. When the coupon rate equals its effective interest rate, then that means the bond is at fair value. Okay, so so that means the 8% is equal to the coupon rate of 8% is equal to the market rate of 8%. It was like telling you the bond coupon rate is equivalent to its effective interest rate. Okay. And since there is no transaction cost, no premium or no discount, then basically there can't be a difference between market rate and interest rate. Okay, and coupon rate. They say the credit risk since initial recognition of the bond is determined as follows. Okay, on 1 January 2020, low credit risk. On 31 December 2020, no change since initial recognition. Okay, so let me explain what we're going to do over here. Okay. So on 1 January, so we see that, and then they say the details relating to the bond, 1 January, 31 December, and then average rate 2020. Okay, so there's the fair value, and then here they're giving us, this is for credit losses. So they're giving us the 12 month and the lifetime. So you need to know when to use the 12 months, when to use the lifetime. At initial recognition, we will always use the 12-month expected credit loss unless it was high risk, okay? Unless it was like super high risk. And that is because you, so basically it's like if you're buying a junk bond, if you're buying a junk status bond, we call it junk bonds, then you will use the lifetime because you know you are entering into a bond that is high risk. But other than that, a financial asset at initial recognition, when there's impairment that needs to be applied, then we will use it. It would be we'll use a 12-month expected credit loss. Then subsequently, you will continue using the 12-month expected credit loss unless this has changed. Unless they say there's been a significant increase in the credit risk. So when you see significant increase in credit risk relative to initial recognition, then you must know you can't use the 12-month life expected. You can't use the 12-month credit loss. You'll have to use the lifetime expected credit loss. Okay, so just take note of that. So they say at no stage was the bond considered to be credit impaired and the interest payments were received on time. Okay, so that indicates that you will continue using the 12-month. You won't use the lifetime column. They say assume that the South African Revenue Services will not allow expected credit losses on the bond as a deduction for income tax purposes, and that the SARS accepts the amortized costs of the bonds as the tax base of the bonds. Only when the credit risk realizes will SARS allow such losses as actually incurred. So Clarice, this is an example of them integrating test 1 information, test 1 work with test 2. So there you can see you need to know your deferred tax knowledge to do that part of the question. But that is as hectic as it would become. Okay, so the SARS indicated that any future taxable profits will be taxed at 28%. Okay, so let's have a look. So what are we going to cover over here? So what are we going to cover? discuss how Panther Ltd should classify the compulsory convertible debentures. Okay, we will discuss that. So this you will find in IAS 32. Okay, you won't find this in IFRS 9. You will find this in IAS 32, but we will cover that. Briefly discuss how Panther should account for the share. Okay, this is what is this now? Tell me. This is share-based payments. You can deal with that. Prepare an extract of the statement of financial position of Leo as at 31 December, showing the convertible preference shares and the share appreciation rights. I will show the preference shares. I'm not going to show the share appreciation rights. And then we will do the last one. Provide the journal entries to account for the bond for the year ended 31 December in the accounting records. Okay, so that is what we will be covering. I just want to, so I'm going to give you 5 minutes. It's 9:45. It's 9:40 to 9:45. Just try and see how would you discuss the classification based on what I explained earlier. I'll give you 5 minutes. I'll put you guys into one group and then you can talk to each other. How do you classify? I'll put you guys into one group and then you can. So join the group and then I'll give you 5 minutes to discuss.
But we agreed that we are done.
Okay, I'll come now. Okay. So what did you guys conclude?
Okay, I'll then just do the talking. So we decided that it's under the definition of a financial asset because it is an equity instrument of another entity because it will be convertible into their shares. And the equity instrument gives you residual interest in the asset of an entity. If it is a contract that is evidence a residual interest in the assets of an entity. And then we added to say that it's a derivative settled in exchange for a financial asset, which is a number of its own equity instruments. And it is convertible or compulsory convertible for a fixed number of shares, which makes it a compound financial instrument and would lead to an equity instrument afterwards. And the sum of the liability and the equity components will equal the fair value thereof.
Okay. Then, so you see it as a financial asset, but how are you going to classify the financial asset?
As a compound financial instrument.
But there's three.
Equity.
A financial asset can be classified in three things. Amortized cost, amortized cost, fair value through OCI, fair value through P&L. You guys discussed that?
No, we didn't.
Oh yes, we didn't actually touch on that.
Okay.
No.
Okay. So
it would not be at amortized cost because you'll be paying dividends.
yeah. Okay. So it's important to understand the question. So discuss how Panther should classify the compulsory convertible preference shares. They did not tell you discuss it in terms of I-32. They did not tell you discuss it in terms of IFRS 9. They didn't tell you which standard to discuss it in terms of. So you must discuss it in terms of both. Okay. So remember, I-32, that classification deals with whether it's a financial asset, a financial liability, or financial or equity instrument. I-32 deals with that component. Then you have IFRS 9 that deals with classification. Once you know it's a financial asset, now IFRS 9 kicks in to say how do you classify the financial asset. I-32 tells you whether it's a FA, a FI, or an equity instrument. Okay. Once you know it's an FA, then IFRS 9 kicks in. They never told you which standard, so you must apply both standards. Okay, so that means you first need to tell them whether it is an FI, FA, or an equity instrument. And once you conclude, so you correctly conclude it's a financial asset. Now you're like, okay, it's a financial asset. In terms of I-32, whatever you said there. Now you say, okay. Now the classification in terms of the classification of a financial asset in terms of IFRS 9 is as follows. So you're correctly saying it is not amortized cost. Why? Because although it is a bond, okay, so generally bonds is amortized cost. So generally bonds is amortized cost. However, for it to be amortized cost, it must be, you must hold it to collect contractual cash flows, and the contractual cash flows must be solely payments of principal and interest. There is no interest payment. And okay, there is an, what, let me just see, is an interest payment. There's no interest payment, okay? There's a dividend payment, okay? Okay, maybe we can get away with that, although it's a dividend payment, it is still resembles interest because it's a fixed annual payment, so you could get away with that. The second thing is, it is not solely interest and principal, because a principal amount is not going to be paid. It is compulsory convertible into shares, so therefore it can't be amortized cost. Okay, now we are left with fair value. So now I say it cannot be amortized cost, so we are left with either fair value through OCI or fair value through P&L. Now I will tell them, in order for it to be fair value through OCI, one of two scenarios can be either mandatorily or irrevocably elected. In order for it to be a mandatorily classified at fair value through OCI, it should be, it must be, you must hold it to collect contractual cash flows, which you are, and the contractual cash flows should be principal, interest, and a resale. There's no principal and there's no resale. So as a result, it can't be the mandatory one. Now, doesn't mean the other one, doesn't mean irrevocably, can you irrevocably elect it to be classified at fair value through OCI? And the answer over there is no, it can't, because it needs to be a pure equity instrument, okay? A preference shares is not pure equity instrument. There is a fixed dividend payment over there, and so forth. So therefore, it is not. It needs to be a pure equity instrument where it's just purely dividends and capital appreciation. There's nothing of that. There's a fixed dividend payment. There's not like that, those random dividend payments, or like as and when the company decides. So therefore, it cannot be. It does not meet the criteria to be elected irrevocably. So therefore, it has to be recognized through fair value, and it has to be classified, sorry, as fair value through profit or loss. So what's important to take note is the thinking process. When you classify a financial asset, you go through the 3 stages. Tell them whether it's amortized cost or not. Tell them, and if it's not, then you go through fair value through OCI, and then you show whether it meets fair value through OCI or not. How do you show? You run through the mandatory one, you run through the irrevocable one. And if it does not, then you conclude it has to be fair value through profit or loss. Remember, if it's not amortized cost and it's none of the 2 of fair value through OCI, it can only be fair value through profit or loss. So in terms of a classification, so your first part was good. The one in terms of determining whether it's a financial asset, that's great. But then you missed the next part, which is once you have a financial asset, how do you classify? Like I said, if they only said classify in terms of I-32, then you stopped where you stopped. But they said nothing. So that means you must classify both I-32 and IFRS 9. Okay, do you understand that? Are you happy with that?
That was an eye-opener, yes, thank you.
Okay, so you can read the solution. So, and how they go through it. Remember, a discussion question is always going to be more than that. Okay, so if you can at least get 7 out of the points, and that's great. You obviously have to. You can't just have the first 7 points, because you still need to conclude. So you might just make sure you have all the important points up to the point of conclusion. If you don't conclude, you can't get, even if you wrote worth 15 marks, but if you don't conclude, you can't get all 7 points. So just make sure there'll most likely be more marks than 7 marks. But you make sure that you give it all the logical steps. So where there's a financial asset, and then once the financial asset, you want to classify the financial asset. Make sure you cover every aspect, amortized costs, fair value through OCI for both, and then that you conclude it is profit or loss. Okay, so that is the discussion over here. I'm not going to do B. Okay, so now I'm going to do that split for you. Prepare an extract of the statement of financial position for the convertible preference shares. So let me switch over into that part. Okay, so the way we deal with splitting the number is as follows. Okay, so the way we deal with splitting the number is as follows. Proceeds less financial liability equal equity component. Okay, so the equity component is merely the balance component. So the equity component is merely the balance. Okay, and that's how it's worded in I-32. So now we're going to work out all these numbers. Okay, some of these numbers you don't do all these detailed workings, but I'm going to do detailed workings so you can see the thought process. I think it was question C. Yeah, question C. They ask us to do is they prepare an extract of a statement of financial position of Leo Ltd at 31 December 2020, showing convertible preference shares and share appreciation rights. Okay. So C, we want extract of a statement of financial position. So when we prepare a statement, we start off with the company name. We name the statement of financial position, okay, and we put the period as at. Remember, the balance sheet is always as at. All the other 4 statements is for the year ended, as at 31 December 2020. So they didn't ask us to prepare, they asked us only for an extract, okay, so we only put the portion that is relevant. Okay, so the portion that is relevant, equity and liabilities, that's the section of the balance sheet, and it's going to be non-current liabilities and it will be current liabilities. Okay, so okay, so this would be equity component. I think they call it that. Equity component. This will be I mean, we can see the name they use. I can't remember what name. I think that is pretty decent to put it like that. And then what you might just know, I'm not going to do the numbers, but just so you know that share appreciation rights is a liability. It's a non-current liability. Okay, so that is how it's going to look. So that is answering the question. Okay, they asked us to prepare an extract of the financial position with the convertible preference shares and the share appreciation rights. Share appreciation rights, if you read IFRS 2, there's a section in IFRS 2 called share appreciation rights. Share appreciation rights is under so there's two types of share-based payments: an equity share-based payments and a liability share-based payments. Share appreciation rights is under the section liability or cash. Under in IFRS 2, there are two types of share-based payments: equity settled share-based payments and cash settled share-based payments. Equity settled share-based payments is an equity you'll fall under equity. Share appreciation rights falls under cash settled share-based payments. Cash settled share-based payments is a liability. So since share appreciation rights falls under cash settled, and cash settled is a liability, that is why that will be under liabilities. And because it's more than 12 months, a long-term thing, it will be under non-current liabilities. Okay, let's see what we can call it. It's better like this: convertible. Okay, so there we have that. Now we can do the calculation. Okay, so now we have at least set up. Remember, if I do my calculations and I have nothing over here, I get 0, even if my calculations is 100%, because it didn't ask me to calculate the numbers. It asked me to prepare the statement of financial position. This is a statement of financial position. So as I calculate numbers, I'm going to go plug in. Very important. Okay, so now we're going to do proceeds. Okay, I'm going to do detailed calculations so you can see proceeds. You can simply just calculate over here. So with the proceeds, remember what? Where's this now? So with the proceeds, we issued 800,000 at 10 Rand per share. Okay, so it's going to be 800,000 times 800,000 shares times 10 Rand per share. So 800, 1, 2, 3 times 10. Okay, Now we must get the liability component. The way we get the liability component is to work out the fair value of the liability, is to work out the present value of the liability as if there's no conversion rights. Okay, so we want the fair value, which is the present value. In order to get the fair value, present value, we have future value, PMT, N, and I. Okay, so I is the market related rate with no conversion rate. So what is the market related rate without conversion rates? It is at 10% per annum. Okay, so what is the conversion rate without what am I saying now? What is the market related rate without conversion rates? It is at 10%. So I plug in here 10%. Okay, N is the number of compounding periods. N is the number of compounding periods, or the number of payment periods. Compounding payment, same thing, similar thing. Okay, so number of compounding periods, number of payment periods. Now, the way you calculate that is the number of years times the number of payments, or the number of compounding periods per year. So we know the number of years is 5. The payments is an annual dividend, so that means it is 1 payment per year, so therefore N will be 5. So N is number of years times number of compounding periods per year, or number of payments per year, which is 1, so that is 5. Okay. Then PMT. PMT is the fixed regular payment. PMT is the fixed regular payment. Okay, the way we calculate PMT is basically face value times the coupon rate. So you must always distinguish between the coupon rate and the market rate. The market rate will always be at I. The coupon rate will be at PMT, because remember, the physical payment that takes place is based upon what you and the other party agreed upon. So what you and the other party agreed upon is the coupon rate, and that is at 12%. So it is face value. Face value is number of shares times the face value. So it's 800,000 shares times the face value of 11 Rand. So face value of 11 Rand. So times the coupon rate, which is 12%. So if I work this out, 800,000 times 11, so 8.8 million is the face value times 12%. Okay, so the payment is 1056. Future value, that is the lump sum payment at the end of the period. This is the lump sum payment at the end of the period, which is basically face value plus a premium, or face value minus a discount. There's no premium, there's no discount, there's only a face value, which is basically 800 times 11 Rand. Take note, future value and payment must be in the same direction. So I always just keep future value and payment positive. Future value and present value will always be in the opposite direction. So what you will notice, the present value will come to a negative number. So we're going to say equal present value, open bracket, they want I first, then they want N, then they want PMT, then they want that, then they want face value, then they want to know when, then they want to know when does then they want to know when does what happen now? I'm trying to say when does payments happen? Okay, let me just see something's not right over here. Am I doing this right? Something's not right. So LTD is 800 times 10 Rand. Okay, dividends are paid annually in arrears on 30th June. Okay, 11 Rand compulsory. Preference shares issued. The fair value of one convertible preference share me just see I'm doing this right. That number doesn't seem right. Yes. Equal present value. So it's right period payment future value into beginning. Okay. So right period payment. Oh, there's no future value. That's why. Okay. Times that 0. Okay, so remember there's actually no future value in this case. Take that away. This will be 0. So let me just explain this actually. So remember, we know that there's not going to be a principal repayment because we're going to convert into shares. Okay. However, when we work this out, we want to work out using the same instrument, but without a conversion rate. So the 10% is out conversion rate, but there's no future value. There's no lump sum payment at the end of the period. So just take note of that. Don't make the same mistake I just did now. We don't include the lump sum payment. Okay. So that means the future value of the liability component is 4 million rand. So we plug that in over here. It needs to be positive. Okay, this is going to be working 2. So the equity component is simply going to be that minus the equity, the liability component, and then as a result, the equity component is 3996. The equity component never changes, so we can simply go plug that in over there. The equity component won't change, so we're going to have here working 1. Okay, now we must deal with the, so remember this calculation is happening. This calculation happens on 1 July 2020, but the financial statements over here is showing 31 December 2020. So this calculation happens at 1 July 2020. At initial recognition, you do that split. Equity component never change. It will remain that number, okay, all the time. But the liability component will change as a result of dividends, of interest, and so forth. Okay, so just take note of that. So now we need to work out what is the convertible preference shares at 31 December. What is the liability component of the convertible preference shares at 31 December 2020? This numbers is at 1 July 2020. This number for equity won't change, but the liability component will change. So we need to work out what is the financial liability component at 31 December 2020. So let's have a look. So the only thing that can happen, the only thing that can change with the liability component is a payment and is the dividend or the interest part. Okay, so let's have a look. So we'll have we are on one in the 2020 financial year. So the balance, there was nothing at 1 January 2020 because we only issued this on 1 July 2020. So the balance, the first balance in the 2020 financial year would be 1 July 2020. The only two things that can change this thing, the only thing that can change the liability component is interest, in this case, dividends. okay, and then interest expense, okay. So the balance over here would simply be that number over there, okay. Now the payment will be 0. Why is it 0? First payment only on 30 June 2021. We are still in 2020. That is why that is 0. Now we will be able to work out the interest rate. Okay, so the interest rate will be as follows. The interest expense, sorry, will be as follows. So remember, the way you work out interest rate, the way you work out interest expense would be as follows. Sorry, quickly, just give me a moment. My son just came into the room. Okay, so now we're going to work out interest. Remember how you work out interest? Interest will be outstanding capital balance times interest rate times time. Okay, and that will be interest expense. So what is the outstanding capital balance at the beginning of the period? It is going to be this 4 million. Okay, so remember, we are in the 2020 financial year. Ideally, we want to start with 1 January 2020, but we can't because we only issued it on 1 July 2020. So the outstanding capital balance at the beginning of this period could only be 1 July 2020. So the outstanding capital balance beginning of period is going to be the 4 million. The interest rate, you use the same interest rate over there. So it's going to be 10%. Okay. Then time, how long in the year? This rate is an annual rate. But how long do we have, how long do we incur interest? Only for 6 months, from 1 July to 31 December. So this is going to be 6 divided by 12. So over here, it is equal to 6 divided by 12. So we work that out. It is going to be that multiplied by that, multiplied by that. So the interest expense would be that 200,000. So the balance would be opening balance. Did I have that now? Oh, there, sorry. So it would be over there. So the closing balance would be the sum of all of those. So now we just need to split that between non-current, and current. So how do we split? All we ask ourselves, of this balance, which amount will be paid within within 12 months? Okay, so the interest expense would be that amount. So the interest expense would be that amount. So therefore, the non-current portion would simply just be that minus that, which comes to that balance over there. Okay, so that is basically these different ways of doing the current, non-current. To make your life easy, just take the interest amount, or you take those two amounts. You just take those two amounts and you leave the other amount as non-current. Okay, like I said, the solution may have only one answer, but in reality, there's 2 to 3 different ways of calculating the number. Okay, although out of the 2 to 3 ways, there is one that is most accurate. So this is most likely one of the most accurate ways. So then we just split it like that. What you might just know, even if you didn't split it between non-current and current, you'll probably only lose a mark to a half a mark. So you rather get this number correct. And even if you plug the whole number in there as non-current, you'll just lose 1 to a half a mark for not splitting. But don't now let the non-current and current split throw you completely off. Get first a total number, then you think, how do we split? Okay, so I would just usually take those two numbers as my current and leave, and then say that minus the sum as my non-current. Okay. Okay, so that is basically that component over there. I'm not going to do the share appreciation rights. Okay, so now what I'm going to do, I'm going to, so that is, that was question C. Okay, so this is C. Now we can do the last question.
Sorry, Faiz.
Yes.
So in this question, the conversion to ordinary shares was mandatory. How would our answer change if it wasn't
Mandatory.
compulsory?
Yeah.
Yes.
Okay. Okay. So what would it be if it? So the other option would be there's an option to convert it to ordinary shares, right? So this it's either the option of the holder or it'd be the option of the issuer. So if it's option of the issuer, that's us, we decide. If it's option of the holder, then the investor decides. Okay. So whoever have the option, you always choose the more favorable option for that person. So for example, they told us over here, the value of one convertible share, one convertible preference share was 12 Rand on 31 December 2020. Okay, so what would happen is the following. If someone have the option, okay, so this is just besides the point. I'm just going to draw an orange line across because it's besides the point. Okay, so details. Payment, if cash, payment if shares. So you must have a look what they tell you what the cash payment would be. But typically the cash payment would be the face value, or the cash payment would be the face value plus a premium. Okay, so let's just assume it's the face value. Okay, so let's assume it's a face value. So if it's the face value, it would be as follows. It would be 800,000 shares times 11 Rand per share. So the face value is 8.8 million. Okay, so if it's, so you will have to see what would, so they didn't tell us because they told us it's mandatory convertible to shares. They don't tell you what the payment would be if it were to be, if you had to pay back in cash. But typically, it would simply just be the face value of the instrument, or it'd be the face value plus a premium, or face value minus a discount. Okay, so that shouldn't be too complicated to work out because you're used to working with a face value plus a premium or face value minus a discount when you do WACC calculations. Then the preference shares, they will tell you if it shares, if it is ordinary shares. Okay. If ordinary shares. So they will tell you, so at 1 July 2020, they will tell you what management have estimated the share price to be at the end of 2025. So they will do a calculation, probably a complex calculation, to determine what they expect. So on 1 July 2020, what do they expect the share price to be at the end of the period? Because remember, they're going to incur costs at the end of the period. So they will say, we need to work out what we expect the share price to be. Let's just assume the share price they expect it to be, they expect the share price to be 13 Rand. Okay. Now we know the expected share price at 31 December 2025, or 30th June 2025 is 13 Rand. We know how many shares we have to provide. They told us it is one share for every preference share. So that means it's 800,000 shares. So this would be number of ordinary shares, which based on the scenario, it is 800,000 ordinary shares. How did we get 800,000? They said it's convertible into one ordinary share for every preference share. It could be that they say it is convertible into a half a share, or it will be converted into one ordinary share for every two preference shares. In this case, it's 1-to-1. So just basically 800,000 times the expected share price at the end of the period. I'm making it up to be 13 Rand. So there we go. Now the question is, which number do we use? Now the question is, which number do we use? 8.8 or do we use 10.4? Okay, so which number do we use? 8.8 or 10.4? And this depends on who the holder is. Okay, so who had the option? So option of issuer, option of holder. The rule is the person with the option will always choose the more favorable for them. Okay, remember, who is the issuer? The issuer is the one that needs to pay because he has the liability. The holder is the one that will receive because he has the asset. So if the issuer has the option to choose, which one would the issuer choose? 8.8 or the 10.4? Which one is more favorable to the issuer?
The 8.8.
8.8, because they must pay. So the more favorable one is the cheaper option. So they would choose that one. With the option of the holder will choose the more favorable to them. They are receiving. They want to receive the bigger number. So they would choose that. So when you do accounting treatment, you'll have to factor that in. And then you'll impact it into your numbers. Either in your accounting treatment, if you have the option, you'd use that number. In the accounting treatment, if the holder has the option, you'd use that number because you know a person will choose a more favorable one for them, all else being equal. Okay. So that is just basically that. Okay. What do I want to do over here? So basically the accounting treatment would just basically be if the option is at the holder, then you will do a split. Okay, then you will do a split. You will do a split between equity and debt. If the option is at the of the issuer, then the issuer needs to decide what do they expect to do. If they expect to make payment, then you will only have a financial liability. If they expect to issue shares, then you will have a compound instrument. So in our cases, we won't really have the option one. I think it's a bit more complicated. We'll always have the mandatory one, which will remain as simple as this. But in WAC, you will have this issue over here. Okay, in WAC, you will deal with this, but in accounting, we'll generally just have the mandatory one. So basically, with the accounting one, with the mandatory one, we're always in a split between equity and debt. But if there's an option, we need to decide who has the option. If the holder has the option, then you will split. If the company has the option, then you're not necessarily going to split. Yeah, so I'm not going to go into those kind of details. Okay. So let's go on to the next item, which is going to be this over here. For CTA level 1, you won't deal with foreign exchange. CTA level 2, you will do. Because remember, in CTA level 2, test 2, there are three topics: financial instruments, share-based payments, effects of changes in foreign exchange rates. For CTA level 1, you only have financial instruments. So this, they are basically just testing foreign exchange within financial instruments for CTA level 2. Okay, so let's deal with this question. Oh, sorry about that. Okay, so let's deal with, I don't know which question we're dealing with. Part D. Okay, I'm not going to deal this. You can read through that. Okay, I'm going to deal with part D. Provide the journal entries to account for the bond for the year ended 31 December in the accounting records of Leo. Okay, so let's have a look. Okay, so when you do journal entries, you just ask yourself, identify the various events, then ask yourself at each event date, are there any accounting treatments? Okay. So let's do D over here. So the first date is going to be, let's do this quickly. So the first date is going to be 1 Jan 2020. So on 1 January 2020, what happens? Prepare the journal account for the bond. Okay. Journal narrations are not required. Journal should be dated. Ignore all tax implications. Okay. On 1 January, that is when we entered into the bond. Okay, so on 1 January, that is when we entered into the bond. So on 1 January, the fair value was 120 at 12.50. The amount that we paid, they said, Leo purchased foreign bonds for its fair value. So the payment and the fair value is exactly the same. Remember, at initial recognition, the financial asset must be recognized, or the financial liability must be recognized at fair value. If there's a difference between fair value and payment, we'll have a day one gain or loss, okay, that goes through profit or loss. But in this case, there won't be a day one gain or loss because the amount we paid was equal to fair value. So on 1 January 2020, so on 1 January 2020, we're going to have debit financial asset, SFP, at fair value. Okay, so it's a $120,000, and the spot rate at the date of transaction was 12.50. So we say multiplied by 12.5. So debit 120,123 times 12.5. Okay, so 1.5 million, and then credit bank SFP, the same amount. Okay, happens to be the same. Okay, then at this particular date, I just want to see something quickly. So here you can see they correctly classified it at fair value through OCI. Okay, so they already correctly classified it at fair value through other comprehensive income. Okay, so okay. So remember, there's only two types of fair value through OCI: the mandatory and the voluntary, where you irrevocably elect. It can't be the voluntary one. Why? Because it is a bond. The only way it can be the voluntary, where you irrevocably elect, when it is a pure equity instrument. This is a bond, so it can only be the mandatory one. So when you have the mandatory one, there will always be two parts to it. They will, because it's partly fair value and it's partly similar to amortized cost. Now remember, the amortized costs always have impairment. So because the mandatory one resembles amortized cost, but it's also at fair value, so there'll always be two parts: the amortized cost component, which is like that impairment aspect, as well as the interest component, and then the other part is the fair value gain or loss. So just take note of that. Okay. So now at 1 January, at initial recognition, for amortized cost and for the mandatory fair value through OCI, there will always be an impairment journal entry. Okay, so we will have debit expected credit loss. Because this is fair value through OCI, the expected credit loss goes through OCI. Okay, and then it'll be expected credit loss reserve. Okay, and that would be equity. Okay, so just take note of that, or as you guys would say, or not you guys, as UNISA would say, SCE. Okay. So just take note of that. The way you're going to get that, we have two options, either the 12-month or the lifetime. At initial recognition, we always use the 12-month unless it is a junk bond. Okay. I don't think we go into that level of detail, but so at initial recognition, it will always be the 12 months. So we use the 1.8, and at that date, it is 12 Rand 50. So it'll be equal, what is this now? 1.8 times 12.5, and it's going to equal the same. Okay. So there we go, 1 January 2020. Okay, and then we're going to have 31 December 2020. Okay, there's no other dates happening over there. So what happens on 31 December 2020? There are typically three things that will happen. So let's explain what are those three things. So on 31 December 2020, what would happen? It is, so here you can see the bond has a 5 years to maturity and carries an arrear annual coupon rate payable on 31 December each year. So on 31 December, one thing that will happen is the coupon payment, okay? The second thing that will happen is that you must adjust the credit loss. Okay, so as you can see on 1 January is 1.8, and on 31 December was also 1.8 or 2.75. So either you must go from 1.8 to 1.8. So you can see there's nothing that needs to be done if you're using the 12 month, but if you're using the lifetime, you will go from 1.8 to 2.7. I'll explain now when do you use 12 month, when do you use lifetime. But basically, there are three things that you need to do. One, it is record the coupon payment. Number two, adjust for the change in expected credit loss. Number three is to adjust for the fair value. There you can see from 120 to 128. There's an 8,000 Rand difference. And then in this particular question, the fourth thing that you need to account for is the foreign exchange gain or loss. Okay. For CTA level 1, there won't be Forex. For CTA level 2, there can be Forex, like in this case. So typically there will be three things: the coupon payment, the expected credit loss, and the fair value gain or loss. The number 4 in this case is the foreign exchange numbers. Okay, so just take note of that. Okay, so let's deal with a Forex. Okay, so so you can see the fair value is equal to the face value, which is also equal to the amount to be paid. So remember, all three numbers could be different. The face value, the fair value, and the payments could be different. But in this case, all three is the same. The importance of the fair value number is that the financial asset is always recognized at fair value at initial recognition. The importance of the payment number, that will be the bank transaction. So in here, the financial asset at initial recognition must be at fair value. The bank will be the actual cash flow. Because the two are the same, that's why the numbers are the same. Then the third is the face value. The importance of the face value is that we need the face value to work out the coupon payment. So because the face value equals the fair value, we will use the fair value in calculating the coupon payment. So just take note of that. I don't think it's always going to be the same. It happens to be the same in this scenario. So let's deal with that one first. Let's deal with the coupon payment. So remember, we have a financial asset. So who gets the coupon? The person, the holder who has the financial asset. So who gets the payment? The holder, the person has a financial asset, which is us. So therefore, we will say debit bank. If we were the issuer, we would have said credit bank, because we would have to do the payment. So So just pick up those kind of nuances. Okay. So when you say debit bank, it's FP. The bank is the coupon payment. Okay. So the bank is the coupon payment. So how do we do this? We say face value. Face value happens to be fair value. So it is 1.5 times the coupon rate, which is 8%, times time. How long in the year? In this case, it was the full year. So 12 divided by 12. So I say debit 1,500, 123 times 8% times 12 divided by 12. But now just take note that this foreign currency. Sorry, I must not do that. I must use the, not the 1.5, I must use the 120. Okay, so this is Forex. We multiply by the spot rate on the date of payment. So the spot rate on the date of payment is 13.75. Okay, so just take note of that. Don't make that mistake now. I just did. I use the 1.5. If it's not foreign, then you can use, but because it's foreign, we use the foreign number, because when they pay us, they don't use 1.5 million rand. They pay us based on $120,000. So $120,000 times 8% times 1 year, 12 over 12, times the exchange rate at the date of payment, which is 13.75. So let's work that out. So 120, 123 times 8% times 12 divided by 12 times the exchange rate, 13.75. Okay, so that is what they would have paid us. So now we want to work out the interest income. Okay, so interest income, because we're earning interest income, it will go through profit or loss. Income goes through profit or loss. So we once again, we're going to base it on the face value, $120,000. But now we don't use the coupon rate. We use the effective interest rate. Okay, what did they tell us? It's effective in the bond coupon rate is equivalent to the effective interest rate. So that is why we're also using 8%. We don't always use 8%. We don't always use the coupon rate. It just happens in this question that the coupon rate and the effective interest rate is the same. So we also got it for 12 divided by 12. But here comes the important aspect. The bank amount happened at a particular point in time. Interest income, however, is earned over the year. So therefore, the exchange rate we use must be the average for 2020. So we have to use 11.12. This will be times 11.12. So the income, so it's on the credit side. So we say 120, 123 times the effective interest rate, which happens to be the same as the coupon rate, times time, multiplied by the average exchange rate, which we earned interest throughout the year. So 11.12. So there we can see that the thing doesn't balance. So the difference will go over here, which is equal to 132 minus 106. So that will go against the financial asset. Okay, I just want to keep tabs over here. Okay, so 1 Jan 2020. Okay, so this is initial purchase. Okay. Okay, so remember that is that we don't know that. So that is 1.5 a debit. Let me just do this, equal 1.5 Then 31 December 2020, net coupon interest income, and it was a credit, so it's negative. Okay, so it's a credit, so it is negative. I'm just keeping tabs so we can see the balance as we go along. Okay, so we did the first part. Now let's do the expected credit loss part. Okay, so the fair value adjustment needs to be the last number we do. Okay, so the fair value adjustment will be the last number we do. We first do the interest and the coupon, and we do the expected credit loss. So we have an expected credit loss of $1,800. Okay, $1,800. We use a 12-month expected credit loss because that's what we use usually, and it was low credit. Okay, if there was no significant change in credit in the credit status, then if there was no significant change in the credit risk, we continue using the 12-month expected credit loss. If there was a significant change in credit risk, then we must move over into lifetime. They told you no change since initial recognition, meaning there's no significant change in credit risk. So therefore, we continue using the 12-month expected credit loss. As you can see, the credit loss remained the same. Okay, so the credit loss remained the same. So there's no change in the impairment. However, so this credit loss, there's no change. We're not going to recognize an additional credit loss. Okay, so we're not going to recognize an additional credit loss. Why? Because there's no change in the credit loss. It's still 1.8. However, this 1.8 is a foreign number. So this 1.8 was based at 1250. Now this 1.8 is going to be based at 1375. So there's only a Forex adjustment that needs to be processed. Okay, so there's only a Forex adjustment that needs to be processed. So what we're going to do is the following. So the win to, what did it happen now? So the number is going to be, so remember what we had, expected credit loss was 22,500. So it's going to be 22,500 minus the new number. What is the new number? The new number is still 1.8, but based on an exchange rate of 13.75. So I don't know what that gives us. Let's just see. 22,500. And that gives us 1,800 times 13.75. So that gives us 24,000. Okay, so there's a difference of, so we have a debit, is it that minus that? So you can see the exchange rate increased. So it's a negative impact, so therefore it's going to be a Forex loss. So let's understand why that makes sense. Why is it a foreign exchange loss? This is an expense, right? This is an expense. The expense in dollar terms remain the same, but initially it was based on 12.50. So the expense was 22,500. Now it's based on 13.75. So the expense is now 24,000. So you can see the expense increase, and an increase in an expense is a decrease in profit or loss. A decrease in profit or loss is a decrease in equity. A decrease in equity is a debit. Okay. equity decreases on the debit. So therefore, we're debiting profit or loss with the 2,000. We're not going to call it expected credit loss. The reason why we're not calling it expected credit loss, because the credit loss is still 1.8 thousand. It didn't change. The only reason it changed was as a result of foreign exchange. So that is why we call it foreign exchange loss. So I need to think now. I'll just need to double check this, but I think foreign exchange always goes to P&L. Even though it relates to the expected credit loss, I just need to double check this. I'm going to highlight this in red. I can't now remember with certainty, but I think a Forex always goes to P&L. Okay, that expected loss will go to OCI because it relates to a financial asset. Okay, but I think Forex always goes to P&L. We'll check. I'll check just now. So then where do we take it against? We will take it against the expected credit loss is not changing. So that will remain the same. So all that will happen, we will take it against the financial asset. Okay, so here we go again. So as a credit to financial assets, I'm going to say negative that. Okay, so we dealt with number one, the bank. We dealt with number two. What did we deal with number two? We dealt with number two. What did we deal with number two now? We dealt with number one, which is the coupon and the interest income. We dealt with number two, the expected credit losses. Now we need to deal with the fair value gain or loss. Okay, so now we need to deal with the fair value gain or loss. I just do here now. So now we need to deal with the fair value gain or loss. As you can see, the fair value gain or loss is a fair value adjustment between 120 and 128. So this is a tricky one because there's a fair value gain or loss from 120 to 128. So we know there's a fair value of 8,000. Now there's also an exchange rate gain or loss, 1250 to 1375. So I think UNISA splits it out, but if you read the accounting standards, so in IAS 21, they actually tell you there's no need to split it between what relates to a fair value and what relates to a foreign exchange, which is a bit complicated to work what relates to the 8,000 and what relates to the purely as a result of the fair value gain or loss. So IAS 21, I'm 100% certain, I read it a few times, that there's no need to split between fair value and foreign exchange. I think you can lump all of it as fair value, but I do think UNISA still splits. We just need to check. I just want to go check quickly if UNISA splits it. Okay, so Unisa want you to wants you to do this, to do the fair value adjustment, so we will do it. Okay, so just to take note that this will actually be OCI. Okay, I will double check when I read IFRS again, whenever I read it. So that will be OCI. So the foreign exchange will also go where the underlying transaction is. So because it lays on financial asset at fair value through OCI, the forex will also go through OCI. Okay, saying the credit losses will go through OCI, but obviously interest income will always be profit or loss. Please make sure you get these stuff right. If you don't put it in, you won't get marked. If you put it in consistently as wrong, you will get penalized. Okay, so just make sure you get that right. So let's do the fair value adjustment. Okay, so the way we do the fair value adjustment is as follows. We still keep it at 120. Okay, that was at the initial recognition, 120. So what's going to happen? So the forex adjustment is simply going to be 1250 versus 1375, still using 120. So all we're going to do is as follows. So the calculation, we know 120 times 1250 was 1,500. Okay, so we know that was the initial amount. Now we compare it to still 120, but using the new exchange rate, which is 13.75. So that we can see the asset was initially recognized at 1250. Now the asset is going to be recognized at 1375. So the exchange rate is going to increase the asset. Okay. So because the exchange rate is going to increase the asset, an asset increases on the debit side. So we're going to have financial asset. We're going to debit the financial asset. So what's the amount going to be? 1,500, 123, which is 120 times 1250, the amount at 1 January 2020, minus still 120, because we're trying to get the exchange, we're trying to get the exchange rate impact. 120, 123 times the new exchange rate, 1375. Okay, so okay, so it's going to be 150, and let me just quickly see. Need to take that number over there, sorry. Yes, we're going to use that number, we're not going to use the 1.5. We're going to use that number over there, which is the 172,502. 172,502. Okay, so we have changed that over here. 1472502. So that is going to be the increase in the financial asset. And what is it going to relate to? It's going to relate to a fair value gain or loss. It's going to be a credit. So it's going to be the same amount. So what's happening to financial assets? Okay, and then we're going to have again 31 December 2020. This is going to be Forex on financial asset. So as you can see, the financial asset has been debited. So we just add that over there. We get a new balance. We get a new balance, and the balance is balance before fair value adjustment. So the way we're going to do this fair value adjustment, we get the balance now, whatever this balance is, 1650. So the fair value adjustment is going to be 1650123 minus $128,000. 128,123 times the new exchange rate 1375. So that would be the amount. I don't know what it comes to. Let's just see. Equals 1650123 minus 128,123 times 1375. Okay, so let's make it ABS. Actually, let me just do it like this. So it's 1650123. That's going to be 128,123 times 13.75. So there you can see the fair value. The current balance is at 1650. The current balance is at 1650. The balance should be at 1760. So what's happening to financial assets? Financial assets needs to increase. So financial assets is currently 1650. It should be 1760, which is the 128 times 1375. So therefore it should increase. So an increase to an asset is a debit. And this is going to be fair value gain OCI. So all we're going to do over here, same date, fair value gain 110 as a debit. So we say we have it positive. So the balance should be what we expect. The balance should be what we expect. Balance calculated equal the sum expected balance which is $128,000 at 31 December 2020 times the exchange rate 1375, which is 128. We know it's right. We already did the calculation. 0.75. So there we go. The answer is correct. So we need to get to the 176. We just needed to make sure that the movement from 1.5 to 1.6, the movement from 1.5 to 1.6 are all the items highlighted in green. So the movements or all the transactions The case from 1.5 to 1760 is highlighted in green. We needed to make sure that we're having the correct movements to the correct places. So that's basically the journal entries over here. So remember, the journal entries are fourfold. One, the interest income and the coupon payment. Number two, the expected credit loss. Number three, the foreign exchange. And number four, the fair value gain or loss. If you are CTA level 1 and perhaps third year, you won't have the forex. So that's it from my side, guys. Is there any questions from your side? If there's no questions, then we guys are good to go.
Hi, Faiz. Sorry, just
Yeah.
a quick one. So for financial assets that are classified at fair value through OCI,
Yeah.
the interest always goes through profit and loss. Is that correct?
Yeah.
Okay.
Yeah. Any other questions? With no questions, you guys are good to go. Hope you found it beneficial and useful. Okay, bye-bye.